Welcome back to Kitco News. I'm Jeremy Safran. Well, billionaire trader Paul Tudor Jones, famous for calling the 1987 crash, just told CNBC that the stock market is heading to new lows, even if President Trump rolls China tariffs back 50%. Now, Jones says tariffs this high are the biggest tax hike since the 1960s and could shave 2 to 3% off of growth. Now, that warning lands as fresh new data shows the U.S. trade deficit exploding to a record $140 billion in March, driven by a pre-tariff import rush that sliced first quarter GDP into negative territory. Now, joining me is Ted Oakley. He's the founder and managing partner of Oxbow Advisors, a multi-billion-dollar wealth firm that manages money for high net worth individuals and family offices. He's also the author of a new book called Second Generation Wealth. Now, Oakley has over 40 years of experience and is currently holding 50% cash, betting that falling corporate margins and falling PEs will deliver a double hit to stocks. Ted, great to see you. Good to have you back.
You bet, Jeremy. Good to see you.
Okay, we have lots to discuss. I know that you've seen a thing or two before, but as I said off the top, billionaire hedge fund manager, he's kind of a legend here. Paul Tudor Jones just said that even if President Trump rolls back China tariffs by 50%, it wouldn't be enough to save stocks from hitting new lows. Now, you've been warning about underlying deterioration for quite a while now. Do you agree with Jones? And if so, how far does this correction go here, Ted?
Well, you know, Paul Tudor Jones is a good money manager for sure. I've known him over the years and watched him over the years, and he's excellent. What he says, I'd have to agree with him right now for sure, because you know you're in a situation where it's interesting. Where the retail investors just whistling past the graveyard here, because what's happened, and I'll just give you a couple of things. With these numbers dropping down, and what we get this next 90 days is important, because you're probably going to have margins come down. You're going to have earnings come down. And you're still at a 21 multiple on the S&P right now, right at it. It's just under 21, which is not cheap in any market. So if you have the multiple drop and the earnings drop, you know, you could see that take it to new lows. It wouldn't surprise me. But I will tell you that retail investors, the individuals out here, they don't see it. And they're making some pretty big errors right now.
Yeah, I mean, we got that important trade report to add to it, too. I mean, the U.S. trade deficit soared to a record $140 billion in March, of course, driven by companies rushing to import goods before the tariffs hit. But, Ted, this comes alongside with, this 0.3% drop in GDP, and it suggests that the U.S. economy might be weaker than, as you mentioned, headlines are implying. So what does it tell you about the state of the economy? I mean, break it down for us here. How does it tie into your thesis that things are unraveling below the surface?
Well, I think it was camouflaged in the first quarter, because what happened is there was a lot of buying by individuals and by companies, buying inventory. They're doing different things, and it looked better than it really was, but they were just getting set up for something to come in this quarter. I think now you're starting to see this quarter, and all of a sudden you're starting to see those things take place. I'm talking about shipping. You look at shipping, these ports, not a lot going on those ports, and they're all issuing reports about that right now. And then if you look at the price of oil, it's telling you, hey, this economy is slow. And it's always a good harbinger of what's going to happen. And I think Wall Street, though, in their ever-loving quest of stocks, can't see it. And so they just keep on buying, and that really doesn't make it until it finally happens. And then it's too late almost.
Yeah. I mean, let's zoom out a little bit. What's deteriorated most since I had you on? I mean, you mentioned in the past interviews, when you look across real estate, you just mentioned shipping, which is a huge one. I mean, trade, corporate margins, you're seeing a pretty broad-based deterioration. Last time we spoke, what's worsened most in your view here?
Well, I think the worst thing since I saw you last time was the fact that if you look at the underlying part of the economy, and that's where shipping and trucking and buying things and putting things in inventory, all of that's really tightened up now. And so that is a problem, because that's really the lifeblood of an economy, when you're moving things around, buying and selling. But all of a sudden, that's coming to a halt, or at least slowing down dramatically. And then you have all of these countries. All of a sudden, you create a situation where instead of one country disliking you, every country dislikes you. And so all of a sudden, you see what happens with all of that. And I think that is just now showing up, but it's going to be there in full force here over the next 1 and 2 months.
Yeah, interesting. Okay, well, 1 and 2 months, you were just talking a little bit about Wall Street. Throughout the year, we've been talking about that divide between Main Street and Wall Street. I mean, sentiment says bearish, but the positioning says otherwise. Well, I mean, what's going on? The American Association of Individual Investor Survey shows investors are extremely bearish. But as you just talked about, I mean, fund flows show that they're still fully invested. You've called it the sign of deep complacency. So explain the disconnect. What kind of event typically breaks that kind of behavior?
Well, it's usually a deeper break in the market where all of a sudden everything they've been buying. I'll just give you an example. If you look at if you look at the consumer estimates that have come out in this particular month, okay, individuals were the highest level since 2011, expecting a market decline. And yet in April, they put more money in the market, 40 billion retail investors, than any month in the last 5 years. In other words, they've been so set up to buy the dip since in the last 16 years, they think the Fed will always come to the rescue. That's the way it's been. And so you've had this whole setup here where particularly retail, I mean, individuals, I think they're the ones that are going to get hurt the most here because they kept buying it and their advisors have kept telling them to buy it and Wall Street's kept telling them to buy it and they don't look at valuations and all of a sudden and go look at the numbers. I mean, we have the most stock. If you look at liquidity in stocks are on the highest now than any time in history by families, anytime. And I've got all the numbers going back, but it's huge. And so they're all in right now and there's nothing left to happen. But when the prices go down, then all of a sudden you see them really start to do the things that they shouldn't do, which is sell at the low. But that's what happens in this game.
Panic. Yeah, the panic starts to kind of get involved in the market there. I mean, to your point, you're holding more than half of your portfolio in short-term treasuries right now. What's the trigger to start putting that cash to work? I mean, are you watching for any specific valuations? Is there spreads or signals?
Yeah, we just look at companies. We look at the market will tell you usually what the companies are doing too. But if you look at the average company that we screen, which is about 250 companies, they're all at the top end of the expense range. I mean, they're expensive. Now, not all of them are because we own about 25 companies. Don't get me wrong. And we'll buy a company, bought one this week. We'll buy a company if it hits a number that we think is going to really work in terms of the next 5 years. And so there's companies that come away with that. But I'm just saying, by and large, if you run a screen on those companies, you're going to have very few companies relative to what you would have seen, for example, at a market low, which will have 95% of the companies are cheap. And you just decide what you want to buy. We're at the other end of that right now. And that's how we look at it. But it's not because we're trying to time the market. But if we can't buy something right, we just rather hold the money in cash right now and take the 4.25%, and we'll wait on it.
Makes sense. So you're not buying the dip, but if you see some value there, if you see a sale, you're jumping into the market. I mean, can you share who you are looking at? What kind of company are you purchasing at this point? I mean, what kind of equity?
Well, I'll just give some recent examples in the last 60 days. A couple of months ago, we took positions in 2 fertilizer companies, Nutrien and Mosaic. We think the fertilizer business is actually going to do well because of this stuff that goes on in the shipping and foreign and U.S., but also because that's a commodity that we want to own for the time being. We don't always own those, but we want to own that. You'll see where we bought Unilever, great food company worldwide. We don't think they'll be affected that much by the tariffs. When the prices were lower 6 weeks ago, we bought AbbVie and we bought Novartis. They've both done really well in the last 6 weeks. And we'll buy something correct. Yesterday we bought, we've owned this company a little bit, but we bought more of it, a little company called New Gold, which is, it's a small dollar price, but it's a small stock that's selling at about 3.5 times 2026 cash flow. That's a cheap company. You think about that. Yeah. If it were to go to 6 times cash flow, which would still be really, really cheap, you'd almost double the stock. And so that we look at things like that, and that's with the price of gold that valued through that cash flow at $2,800, not $3,400. So you've got a buffer there all the ways. We look at things like that. Now, they don't, we try to buy them in a cheap way. Obviously, we own a lot of gas pipelines. A number of our pipelines pay 8 and 9%, and that helps us through this sort of thing too. So there's a lot of things you can own, but you have to really know what you own. You can't just go in there and say, I'm going to buy the index here. And I'm certainly not going to buy there's all these big mega stocks. I'm not going to buy the big mag 6 or 7. Really, Microsoft's done better. We own some Microsoft, but the other 6 are not doing well at all. So that's the way we look at it.
Does it surprise you? I mean, Ted, in this market, I mean, as you mentioned, retail still getting into these Meg 7 stocks out there. And you've warned about, a double hit scenario, falling corporate margins, failing valuation multiples. Walk us through what that looks like in practice. If this plays out, are we looking at a 4,000 on the S&P, or is it even worse?
Well, let's just say the street has a 270 earnings on the S&P. Let's just say it's 240 or 250. I think it would probably be more like 240, but let's just say it's that. And then all of a sudden, if you take that and you go from a 21 multiple to say a 16 or 17 multiple, you're 4,000 on the S&P or lower. And usually you don't stop at those round points. You'll go lower and make a low. That could happen. I don't know that it happens. Maybe people keep on buying it even though they're super expensive. But that's the way I would view the numbers. If I was looking at a macro situation for companies, we just look at them, and when they get in a position where, and we run the numbers on our own way, that we try to hold things, over 5 years. And so a lot of companies we've owned 10 years, 12 years, but when they get cheap enough, we'll buy them. And if they go cheaper, we'll probably buy a little bit more of them. But we're trying to own companies, right now.
I wonder if they will get cheaper with the current macro landscape. I mean, there's companies like Mattel, the American multinational toy manufacturing and entertainment company. They're already raising prices before the tariffs even take effect. So what does that suggest to you about the supply side inflation dynamic? And what kind of an impact could this have on both margins and consumer behavior in the second half of the year?
Well, I think that's what the Fed has been worried about, is because there's a term they use for that where inflation is locked in with companies that really may or may not be bringing things in from overseas. And they all raise their prices at the same time. And that's what you're seeing now. You're starting to see that. And I think that's what bothers a lot of people, is because that shows up. But see, the Fed's always really come to the stock market and helped it out and been a Fed put over the last 16 years. But here's a problem. If you're raising prices, you have inflation, they can't do that. So all of a sudden, individuals are left without Big Daddy that comes in and helps them out here, because they can't lower rates when you've got inflation running on you.
Let's talk about the Fed here, Ted. I mean, obviously we're watching this upcoming meeting, but what's your read on the next move? I mean, are we still in a wait and see kind of mode, or do you think that rate cuts or maybe a curve shift are coming faster than the market expects?
Jeremy, we don't look at the Fed much because they're wrong so much that it's not something we really use. If I were guessing, they probably don't know what they're going to do till tomorrow, more than likely. But one of the things that they're seeing probably is the same thing everybody else is seeing. The prices going up, people are having a tougher time with that. And my guess is they wouldn't lower rates, but if they do lower them, that'll tell you that they're seeing more weakness than they have been seeing.
Yeah, of course. Well, we're keeping an eye on it over here, let me tell you. Let's go back to gold. You brought it up briefly, but I mean, it just hit a 2-week high. Spot prices traded above $33.90 on Tuesday. A lot of that seems to be driven by a post-holiday buying out of China and concerns about these new U.S. tariffs. But you treat bullion as a currency hedge. How's it behaving now?
Well, it's behaving like you would like. I mean, if you've owned gold, which we have, for some time, then these last 2 years have been good to you, and especially the last 12 months. We own the miners too, but the miners we trade. Those get expensive sometimes. They're not that way now, but they can get really expensive, and you don't want to keep those. The bullion we hold all the way through, all the way. We keep it all the way, and I think people forget about that from a currency standpoint, once the dollar is going to be declining, and the dollar's declined really forever buying power wise, you look at the last 25 years. But if you think the dollar is going to be declining, and I think it will be, I think all of these other countries want to sell the dollar. They want to buy gold. They don't want to put it in the dollar or the assets in the U.S. because they don't trust us.
Right.
And so they'll be buying more gold. And I think for somebody that wants to hedge, if you want to own treasury bonds, for example, you probably should own a little bit of gold too at the same time. But it feels as though that's what's happening in the marketplace right now.
Yeah. So I mean, you got the gold and you got the miners as a tactical play. Is that kind of where you're positioned, like all three strategies here? What would get you to add or maybe reduce risk?
Well, if we had a company that got too expensive, we would cut it back. In other words, if we were looking for a price to come to fruition over the next 2 or 3 or 4 years, and all of a sudden in a 6-month period we get that price, and we're way ahead of where it should be, and we'll probably cut that back some. We won't take it all, but we'll take some of it off. But I think people forget too that back in 2003, Warren Buffett wrote a letter published in Fortune. And in that letter, he said, I've never done this before, but I'm buying foreign currencies now because I think the dollar is going to go down. And then he set up a little idea about how they could issue these certificates that were really a form of tariffs. So you want to get right down to it. But people forget about those things. They haven't been around long enough to remember that. And so for us, we're not buying the foreign currencies. We're just buying the gold because we think it'll stay up with everything.
Interesting. Okay. So you said new gold, and I want to switch over to miners because I know there's a lot of people watching right now that kind of are looking for some names that you're following closely, that investors can still kind of capture upsides. Because as you mentioned, this price of gold, the all-in sustaining cost, some of these majors, they're printing cash right now. But are you looking at the juniors? Any names you can give us that kind of have better?
Well, we own the large names, obviously, because they're the best. And Agnico is our largest holding we have. It's been a great stock for us over time. You'll look and see we own Royal Gold, which is really we like to own things that, for example, that you can get royalties off of, and whether it's oil and gas or gold or silver or anything else. And we own Royal. We own the small company I just mentioned it's a smaller position for us called New Gold, but it's a very cheap small company. But the point I'm making is we own the larger companies that in that minor area. The problem about the juniors is we're not capable of doing the work, but you need to go out and see the mines, know the managers. That's a lot of work. Mm-hmm. And I don't think we're capable of doing that, and so we don't go that direction.
Yeah, Agnico, Sean Boyd, he's come on this show. Just a fascinating company and stock to watch, too. You were talking a little bit about trust with the U.S. right now and saying that some people are kind of hedging against that trust. I mean, the dollar fell 0.2% on Tuesday, and it seems like global confidence in U.S. assets is at least starting to show some early cracks here. Do you think that the dollar's reserve status as the world's reserve currency is ever at risk? Is it at risk in the next 5 to 10 years, or do you think that the narrative is just way too overblown here?
Well, right now it's still the reserve currency. I mean, they can't, even though a lot of the countries are trying to get away from it. Mm-hmm. I mean, most 68% of things that trade now are traded in dollars. So you have to assume that's probably going to continue for some time. Now, I could see over a 10-year or 15-year period that goes lower and lower and lower. I don't think it goes away necessarily, but I think it does go lower because if you look at the BRICS, if you look at Russia and China and India and Saudi and Brazil, all those countries, they do anything probably to get away from doing everything in the dollar, particularly in the petro area. So eventually they'll probably come up with, if you look at those countries, they'll probably come up with some sort of currency on their own. Right now, there's not enough size. You can only deal in either the euro or the dollar as far as size, and so you just have to see how it comes out. But right now, there's still the currency, and doesn't mean that the currency doesn't go down, though. That's the thing.
Yeah. We heard what was it? It was just Warren Buffett this past weekend saying it's really difficult to get away from a system of currency debasement. I mean, China is watching closely here too. The Shanghai Gold Exchange is now planning to expand its vault network to Hong Kong with backing from China's central bank. And I guess the goal is to evaluate the yuan denominated gold trading and give Beijing maybe more influence over global gold pricing. How do you interpret this move in the broader context of de-dollarization that we just talked about it, and what it could mean for gold's role as a reserve asset going forward?
Well, I just think all of those countries, particularly China too, is saying, hey, we're going to put, if they say, okay, look at them in the last 3 years, all the yuan they put into gold, it's done really, really well. All the yuan they put in the dollar, not so well, you see. So they have to look at things like that. And I think they're deciding that, hey, you know what? We're not going to put any more money in these assets here in the U.S. because they don't want us here. And I think they've gotten that message loud and clear. And so I could see them buying more gold and buying more assets in other places, not the U.S.
Yeah. I mean, we're seeing it. We're seeing this really remarkable, kind of figure unfold in the current markets. There's a wave of dollar selling is sweeping through Asia, starting with a record rally in the Taiwanese dollar that triggered deep moves in the Singapore dollar, the South Korean won, the Chinese yuan you just mentioned, even Hong Kong's currency. Now, the backdrop here is critical because for decades, Asian economies used their trade surplus to buy U.S. assets supporting the dollar. But this recent shift suggests that the pillar of dollar demand might be starting to crack. I mean, some analysts are even calling it an Asian financial crisis in reverse. So, I mean, my question is, how do you interpret this dollar unwinding in Asia? Does it mark a turning point in global capital flows? And what does that mean for U.S. dollars and for gold as a hedge against dollar weakness?
Well, I think it started back in the Biden administration when they froze the Russian money. When Russia invaded Ukraine. And so all the other countries said, hey, you know what? If they do that to Russia and there's something about us they don't like, they'd do it the same thing for us. That started a lot of this, I think, and happening. It started, and that was a few years ago, but it's still happening. And I think now, the whole idea now is that, we'll have some dollars, but a lot of the surplus we have, we're going to do something else with it besides buy a U.S. asset or do that. In other words, we're going to put in gold, we're going to put in oil, we're going to put in something, but we're not going to put it where the U.S. has some sort of control over what we're doing.
Yeah. You got this new book too, Ted, and you really kind of talk about this wealth transfer too. And you've said that many retirees over 65 are holding 85 to 90% of their liquid wealth in equities, which is, dangerously high. So for a 70-year-old watching right now, how much liquidity should they be holding?
Well, they have to think about you have to look at it this way if you're 70 years old. What if, and we don't know, I don't know for sure, but it could happen because it happened in 1966. If you look to 1983, nobody made any money in the market. And it's been periods like there's been 3 or 4 long periods like that, 2000 to 2012. So you're 70 years old and you got all this money in the market and you're really counting on stocks to go up, but they don't go up. They may even go down. Okay. And so 10 years from now, you're going to be 80. Now, if you look at your life expectancy at 70, it's probably not over 84, roughly. I'm just giving some rough numbers. So the idea that you're going to try to trade this thing all the way to the end when you only have a finite amount of money doesn't make sense. And so for us, we always say, how much money would you need? This is a question. How much money would you need if the market fell 50% over the next 3 or 4 years? How much money would you need liquid in treasuries, et cetera, that would make you not do something stupid? In other words, not have to really sell things because you're worried about it and you can't sleep at night. And how much is that? And I use that number. And the reason I use 50% is because from these levels that you get this expensive in the market, it wouldn't be unusual to get a 40 or 50% decline. Wouldn't be unusual. And so I think people have forgotten about it because the Fed is pampered in the last 16 years and they're just all hung up in it. And again, I'll give you this number, but if you look, and I got this from the Fed in the end of the year, but if you look, we have the highest level, we're up close to 60% of family wealth that's in the market. All right. Yeah. You know what it was in August of 82? 8%.
Wow. Wow.
See the difference? When it's really cheap, they don't want to
Mhm.
own them. When they're expensive, they really own them. And so they need to keep in mind what's going to happen to me over the next, 10 or 15 years. There's going to be some illness. A lot of things happen. And I just say to people, look, if you've got, you probably have children. The last thing you want to do is show up and say, hey, I lost half my money.
Yeah.
And now you're going to have to help me take care of me.
Yeah.
They're not going to like that.
Yeah. Investors were already somewhat spooked and panicked looking at their ETFs, looking at some of their savings, seeing just that dip that we saw just recently. I mean, how can they reposition without taking massive tax hits or this panic selling that we're talking about?
Well, I don't look at paying taxes as a hit. If you made a lot of money, you ought to be thankful you can pay the tax because you've made a lot of money. And I cannot tell you the times in the last 45 years that I've seen people not sell securities because they'd have to pay the tax. And then that security go nowhere for 20 years. I could give you so many examples of it. It goes nowhere. And so all of a sudden, inflation ate away any profit they did have just because they didn't want to pay the tax and go on to something else that probably would have made them money. Like the drug stocks were like that in the mid 80s, the late 80s, and then they had a fabulous 10 years. All the tech companies, look at Intel, Cisco, all those kind of companies back in the day, and they're still around, but you haven't made any money in them. That's the problem, and I think that's what throws people off. They say, I don't want to pay the tax. Well, you'll pay the tax and then reallocate somewhere else. You don't have to take it all out, but you have to decide, well, I'm willing to pay some tax because I've made a lot of money here.
Yeah, good advice. Let's stay on the book theme here for a second because it's called Second Generation Wealth. And you make a pretty bold claim here. You talk about, the fact that families shouldn't be talking about money with their kids until they're in their 30s. Why wait so long? And what's the risk of starting too early? I found this quite fascinating.
Well, I think it's a fad that a lot of financial planners and a lot of people have gotten in this idea that we're going to bring in kids that are in the 14, 15, 16 years old. We're going to start talking about the family wealth and show them how we manage money and all this sort of thing, and family offices, that sort of thing. I think that is such a mistake because, number one, they don't know a lot at that age. So you're kidding yourself to think that they can take all that information and put it to use the right way. And secondly, you're taking everything away from them. Your kids shouldn't know that you have unlimited wealth and they don't have to go out and work, and they don't have to have ambition, and they don't have to pay bills, and they don't have to live in the real world. What you want them to do is live in the real hard world, the hard world, okay? And if you have to put them out there for 7, 8, or 10 years on their own, you'll find that's probably the best thing you did for that kid, okay? You can bring them back later on, but they learned a lot by then. And I've just found that most of them are not equipped enough to talk about serious, heavy wealth now until they're in 34, 35 years old. And that they're all a little different, but it's certainly not 21, okay?
Yeah.
And I think you take a lot away from a kid and not allowing them to learn to stand on their own 2 feet. I've told this to a lot of people that have really, really large net worths. You want to try to have that child in a situation to where if you have no money at all, that they know they can make it. If you do that, you became a super success with your kids. And then you can bring them back in, and then they'll really appreciate the money. If you started out too early and never have to do anything, never have to work, you're asking for it. I've seen it too many times. I've seen a lot of good people with a lot of money do it the right way. I don't mean to. This book's about what I've seen. It's not about just personal opinions. There are some in there, but it's about what I've experienced over the years and watching people do it, what worked and what didn't work. Yeah. And this whole game has been so easy the last 15 and 16 years that you have all these advisors and everybody that think, it's going to be another 15 like that. And it's probably not. So you want to try to teach those kids to have self-esteem, ambition, stand on their own 2 feet, and know how to treat people. And that they're going to learn how to do that on their own.
Yeah, well said. No, I like it. Something to think about there. Okay, let's do a quick little lightning round here, Ted. It's a quick little opportunity for me to ask you questions, a quick hit for each of these. You just come to me really fast what your thoughts are.
All right.
Where does the 2-year Treasury yield, where is it at the end of the year?
My guess it would probably be around 3.5. You know, because I think we're going to hold inflation up. It might be still at 4, but my guess is it wouldn't go below 3.5.
Okay. Stronger or weaker U.S. dollar by December, end of year here?
I think it would be weaker.
Really? Yeah. And one sector that you would absolutely avoid right now, you wouldn't even touch it with a 10-foot pole.
Oh, for sure. The Mag 7. I think that there's more risk in that group right now than anything else.
Yeah. Going to be interesting to watch it unwind here. We appreciate your time as always, Ted Oakley, founder of Oxbow Advisors and author of The Second Generation Wealth. Thanks for this. Everybody should be reading that book. I'm excited to teach the kids some of these things.
Well, I might say to you one thing, and we do own some of the Mag 7, but there's things that we bought 7 or 8 years ago.
Right. Yeah.
You know, we wouldn't be doing that today. That's the difference between then and now.
Well said. All right. I appreciate it. Thanks for this, Ted.
You bet. Thank you, Jeremy.
Thanks so much.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.